Good afternoon, everyone. This is Henry, and as we get into the free video tonight, I wanted to spend some time on what I find to be one of the most helpful market internal signals. So, needless to say, some pretty wild action as the inflation data hit the wire this morning. You can see the drop from 3640 all the way down to 3500. So, moving directly into something like 3500 is really going to have a huge implication because of its psychological importance. I like to label this way of thinking to say, 1,000, 2,000, 3,000. These will be very important strikes as they are tested. So here kind of, a middle of that in between 3 and 4 is the 3,500. And you can see that we were 2 points away from that being a perfect low. So that is part of the idea that starts thinking that, okay, that could possibly be support. But more importantly than just price, or what really stood out today and what, I think you can take away from days like today, was the put call reading. I've worked on this for a long time now, and I've shared it with a lot of traders. Some look at it and say that there's nothing to be gained from it, but I would encourage you to see that there's absolutely something to be gained from it. You just kind of have to know how to ebb and flow with it, because there will be situations where you have several readings, several days above this 1.0 value, right? And the market can continue to move lower. But when you see values like this on an intraday basis, or like what we had today, and you say, if we see values above 1.0, what would you consider extreme? And a great way of thinking about it, because it adapts to the chart as it unfolds, is to compare it to itself, right? When we look at this with a year of daily data, we can see that this high bubble shows us the highest price that the put call has been, essentially the spot where participants were the most bearish, and usually helps us mark, if not a more important low, at the very least a significant bounce. So that was the highest reading that we had in the past year coming into today, and then today's reading comes just shy of that. So essentially you're just seeing that when you have such a panicked move, you're going to have a lot of your retail traders that come in and say, oh gosh, my stocks are kind of getting hammered, and they're going to buy a put. By that retail buying of the puts, it drives this ratio higher, and then once everybody's piled in to the short side, the market has nothing left to do but to rip higher, and that's a big part of what we saw today. So, I want you to take that forward, continue to use that indicator, in that way. It works in the opposite as well. Should we get to a point, a lot of traders saying, when will I get an opportunity to short? Well, do it in just the inverse. Follow the put-call ratio, and when you see enough of a bullish kind of buying move that it starts to feel a little euphoric, you can see that in the put-call ratio where it will get down here around 0.5, 0.6. So many participants are focused on buying calls that then the market is probably ready to roll over. So I hope that helps and gives you some actionable ideas moving forward. You guys trade well, and we'll see you at the next free video. Hey traders, this is Henry with simplertrading.com. I wanted to thank you for watching today's video. I hope you found it helpful, and if so, be sure to click the like and subscribe buttons down below. If you would like to also see me putting these ideas into action and trading my own account live in front of you, be sure to sign up at simplertrading.com, and I hope to see you in the chat room sometime soon.